£22.40. That's the entire gap this year between the full state pension and the point where income tax kicks in. If you're drawing the full state pension and have any other income at all, savings interest included, every extra pound is immediately taxable. That's where things stand today, and in less than 10 months, it gets worse. On the 6th of April next year, 3 changes to income tax all land at the same time. All 3 hit anyone with savings sitting outside an ISA. None of it will be explained to you in a letter. HMRC won't warn you, your bank won't either. And the window to actually do something about it closes on the 5th of April 2027. Stay with me, because the very last thing I'm going to show you today is the one option that moves in your favour, and almost nobody watching this knows it exists yet. I'm Thomas Ashford, and every week I break down exactly this kind of thing, the rules that quietly affect your money, explained properly in plain English. Let's clear up the first confusion, because it trips people up constantly. The difference between the personal savings allowance and the personal allowance. They sound almost identical. They are completely separate things. A lot of people assume that because their income sits under the £12,570 tax threshold, their savings interest is automatically safe. It isn't. The personal savings allowance runs entirely on its own. It gives basic rate taxpayers £1,000 of savings interest tax-free each year. Higher rate taxpayers get £500. Additional rate taxpayers get nothing at all. And here's the part that matters. That allowance hasn't moved by a single penny since 2016. Let's put real numbers on it. At today's savings rates of around 4%, a basic rate taxpayer with £25,000 saved earns roughly £1,000 in interest. Right on the limit. Fine. Push that to £50,000 and you're earning £2,000, with the second thousand taxed at 20%, so HMRC wants £200. At £100,000 saved, you're looking at £4,000 in interest, £3,000 of it taxable, and a bill of £600 every single year, just on savings. Now, quick pause. If this is genuinely new information to you, hit subscribe right now, because the next part explains something that catches almost everyone off guard, completely without warning. Here's the second problem sitting underneath the first, and it's been running quietly since 2021. The personal allowance, that £12,570, has been frozen. Parliament set it there, and there it stayed. Meanwhile, the state pension rises every April under the triple lock. The full new state pension this year sits at £12,547. The gap between that and the tax threshold? Just £22.40. A year ago, that gap was closer to £600. It narrows every single April. At some point soon, the state pension alone will push past the personal allowance, and every pensioner on the full pension becomes a taxpayer, with no other income required at all. Tax doesn't need an announcement to rise. The threshold just stays still, while everything else moves around it. Here's a situation that plays out constantly, and it may sound familiar. Picture a retired NHS worker, recently widowed, with around £80,000 saved carefully across a working life in a building society account. One day, a letter arrives from HMRC saying she owes £372. She's never had a tax bill in her life and reasonably assumed that because nobody had told her otherwise, her savings were simply fine. What she had no way of knowing is that since 2016, every bank and building society in the UK reports the interest they pay you directly to HMRC automatically every single year, not when asked, automatically. Her account had paid her £2,860 in interest that year. The personal savings allowance covered the first £1,000. The remaining £1,860 was taxable at 20%, and HMRC knew about it before she did. She'd done nothing wrong. She'd simply never been told the rules. What happens next depends on the amount. If the tax owed on savings interest is under £3,000, HMRC typically adjusts your tax code and recovers it gradually through your pension payments. You might barely notice your pension just arrives slightly lower than expected. If it's over £3,000, a formal letter called a simple assessment arrives instead, with a payment deadline, not a request. And if your total savings interest in a year goes over £10,000, HMRC requires a full self-assessment return, the same process as a self-employed person filing accounts. Most people with larger savings balances have never been told that threshold even exists. Over 1.3 million simple assessment letters went out for a recent tax year alone, and that jump has been driven almost entirely by savings interest on balances that, when rates were near zero, generated almost nothing worth taxing. Rates changed, the letters followed. If one arrives and you're not sure the figure is right, ask your bank for a year-end interest statement and compare it to what HMRC says. If the numbers don't match, you have grounds to query it. Now, here's the one that genuinely bothers me, because it's worth real money to people who qualify, and the vast majority have never once been told it exists. There's a third allowance for savings income, completely separate from both of the ones we've covered. It's called the starting rate for savings. If your total non-savings income, pension, employment, rent, sits below £17,570 a year, you're entitled to receive up to £5,000 of savings interest completely tax-free. Not 20% tax, zero. That £17,570 figure is simply the £12,570 personal allowance plus this extra £5,000 band sitting on top of it. The band shrinks by £1 for every £1 your non-savings income goes over the personal allowance, and disappears entirely once that income hits £17,570. Here's what this looks like in practice. Picture someone retired, drawing the full state pension of £12,547, plus a small workplace pension of £953, total pension income of £13,553. Their savings account pays them £4,000 in interest. For a couple of years, they've been paying tax on some of that, because someone told them the allowance was simply £1,000 and left it there. Here's what their actual position looks like. Their pension income exceeds the personal allowance by £930. That reduces their starting rate band from £5,000 down to £4,070. Their entire £4,000 in savings interest sits comfortably inside that band. Tax owed on savings? Nothing at all. The personal savings allowance hasn't even needed to be used yet. They've been handing HMRC money that was never actually owed. For anyone drawing only the state pension, with nothing else on top, the position is even better. The full £5,000 starting rate band is available, alongside the £1,000 personal savings allowance. At 4% interest, that means roughly £150,000 sitting in a savings account before a single penny of tax becomes due on the interest. This starting rate is frozen at £5,000 until at least April 2031, so as the state pension keeps rising, fewer people will qualify for the full band each year. If you think you've been paying tax on savings interest that this allowance should have covered, there's a reclaim form called an R40, free on gov.uk, with no tight deadline for recent tax years. File it and get back what's actually yours. So, the personal savings allowance, the shrinking gap between state pension and the tax threshold, HMRC collecting quietly and automatically whether you expect it or not, and a starting rate band that most people watching this could be using right now and simply aren't. That's the system as it stands today. From the 6th of April 2027, 3 things change all at once, and everything I've just described gets more expensive across the board. First, the income tax rate on savings interest rises by 2 percentage points across every band. This is confirmed in law. Basic rate taxpayers currently pay 20% on savings interest above their allowance. From April 2027, that becomes 22%. Higher rate goes from 40% to 42%, additional rate from 45% to 47%. This applies right across the UK, no regional exceptions. In money terms, a basic rate taxpayer with £3,000 of taxable savings interest currently owes £600 a year. From next April, that's £660, an extra £60 permanently, every year. It doesn't sound dramatic on its own. It isn't meant to. But it's one of 3 changes landing together, and it's specifically designed to work alongside the second. The government's own reasoning is that this narrows the gap between tax on income from work and tax on income from savings. There's a logic to that in the abstract. What it doesn't account for is the retired nurse or teacher who spent 40 years paying income tax on every pound they earned, and simply put what was left into a savings account to be careful and independent later in life. For them, this isn't income from some investment asset. It's their own already taxed money being taxed again at a higher rate than before. And alongside the rate rise, the ordering rules change too. Right now, where someone has income from multiple sources, HMRC applies your personal allowance in whichever way produces the lowest tax bill. From April 2027, that flexibility disappears. The personal allowance has to be applied to pension and employment income first, and whatever's left over, often very little for a retiree, is what then goes against savings interest. Put both changes together, and the higher savings rate applies far more often, because the mechanism that used to soften it has been removed. Now, here's where I have something genuinely better to tell you, and it applies specifically to people watching this video. Money inside a cash ISA sits completely outside the income tax system. The interest it earns doesn't touch your personal savings allowance, isn't affected by the new 22% rate, and isn't reported to HMRC by your bank at all. Nothing changing in April 2027 touches it. From April 2027, the annual cash ISA limit is being reduced to £12,000 for people under 65. But crucially, the same policy confirms that savers over 65 will continue to be able to put up to £20,000 a year into a cash ISA. In a set of changes that moves almost entirely against people with modest retirement savings, this is the one that moves the other way, and it's aimed directly at this exact audience. The 5th of April 2027 is the last day of that tax year. Any ISA allowance you haven't used by then simply disappears. It doesn't roll forward. Here's what that looks like in real terms. Picture a couple, both 68, with £100,000 saved between them, earning 4%, so £4,000 in interest a year. Their combined personal savings allowance covers £2,000 of it. The remaining £2,000 is currently taxed at 20%, a £400 bill. From April 2027, at the new rate, that becomes £440. Now picture that same couple using this year's ISA allowances, £20,000 each, £40,000 combined, moved into cash ISAs before the deadline. That £40,000 earns £1,600 a year in interest, completely tax-free, permanently, regardless of what rates do in future. The remaining £60,000 in their regular account earns £2,400, and after their allowance, only £400 is taxable at the new rate, a bill of £88 instead of £440. Move another £40,000 in the following year, and another the year after that, and over 5 years they've sheltered £200,000 between them. At that point, tax on their savings interest is essentially finished. Same couple, same savings, same income. The only difference is one afternoon and a phone call to their bank before the deadline. For anyone who's already using their ISA fully or holds more savings than 1 year's allowance can shelter, there's a second, completely tax-free option that gets far less credit than it deserves: premium bonds, issued by NS&I, the government's own savings institution, backed directly by the Treasury. Each person can hold up to £50,000, a couple £100,000 combined. Instead of paying interest, every pound held goes into a monthly tax-free prize draw, with prizes from £25 up to £1 million, all completely exempt from income tax and untouched by the new rate changes. The honest caveat: it's not a guaranteed return. Any month you might win above the average rate, below it, or nothing at all. If you rely on a predictable, fixed amount from your savings each month, premium bonds can't replace a savings account or ISA outright. But for a higher rate taxpayer paying 42% tax from 2027 onward, a standard savings account would need to pay well over 6.5% just to match the current tax-free prize fund rate, and nothing on the market currently pays anywhere near that. For someone who's already filled their ISA and has savings left over, premium bonds stop being a gamble and start being a considered response to a system that's just made ordinary savings accounts the most expensive place to keep money in years. None of what I've told you today is secret. It's all published, all publicly accessible, sitting in the Finance Act and government technical notes. What it isn't is explained to the people it actually affects. So here's what to do before the 5th of April 2027. The single most valuable step for most people watching is to open a cash ISA, or top up one you already have, and move savings into it before that date. If you're part of a couple, you both have your own £20,000 allowance. Use both. Before moving anything, check whether your total non-savings income sits below £17,570, because if it does, the starting rate for savings may already be covering more of your interest than you realised, and that changes your whole plan. And if you've received a simple assessment letter and aren't sure the figure is right, check it against your bank's year-end interest statement before paying anything. Back to where we started, £22.40. That's the gap this year between the full state pension and the tax-free threshold. Next April, it'll be smaller still, and the rate on every taxable pound above your allowance will be higher. The people who act before the deadline won't be especially clever. They'll simply be the ones who knew the date mattered. You know it now. If this was useful, hit subscribe so you catch the next one. Tap the bell icon so you don't miss it, and please share this with your partner or a friend who's got savings sitting outside an ISA right now, because one phone call to the bank before next April could genuinely save them hundreds of pounds every single year. I'm Thomas Ashford. Look after yourselves and look after your money.